Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets related, and obviously that impact the physical precious metals. Again, volatility continues. We're seeing a little bit of whipsawing here, and we were light on the charts last week, so we're going to ask Miles to bring it heavy today.
Good thing I came prepared. So, yeah, it's with the up and down, especially in the gold market here. It's definitely worth taking a look just what we've seen since last week. It was completely reasonable to see that little turnaround last week. You had this like 3 drives up pattern with divergence against some of the indicators where you have a rising price but declining divergence in an indicator, or vice versa. If price is going down, you have an indicator that's moving up. Usually signals you're going to have at least a short-term reversal. It doesn't mean you're changing trend, but it means you might have a little short-term reversal. So we saw that decline last week. That made sense. And we thought, there's so much going on. Let's talk about all the other stuff going on. Well, I come back in and I'm checking out charts for this week's show. And lo and behold, instead of gold continuing down, we've gone up and we've put in a double top.
That's right.
Where did that come from? Gold all the way back up to 1824. We're at about 1815 now. Here's what's great about that. So we had this compression going up. We had this reversal I just mentioned with divergence. Makes sense. That happens. That's just trading. And it's still completely reasonable to have seen a correction coming back even down into the 1700s. I mentioned that last week. I mean, you look at where really the breakout move happened. It started, we had the bottom at around 1620. We had this significant breakout up. Then it continued up around 1660, 1670, and didn't stop till 1825. It was almost a $200 move over the course of a month. So to have that type of correction back down makes perfect sense, but we didn't, or at least we haven't yet. So I'm looking at this and I'm thinking to myself, okay, we go back to like October, November, where we got down into the low 1600s. And we ended up having something that generally doesn't happen too often. We had a triple bottom reversal where the price was actually declining into each bottom. So generally what that means is the planks supporting the floor are breaking, and we're probably going to push down to the next levels. But lo and behold, we didn't. We reversed, and we come back up. So I'm looking at this kind of on a shorter term scale. Instead of the course of 2 or 3 months, we look at this over the course of just the last couple weeks. So could we see a double top or a triple top here and a reversal back down into the mid 1700s? Of course we could. Anything can happen, right? But realistically, that doesn't happen much. Usually if you're bumping against a support or resistance level, and each time you hit it, the reaction to hitting it is weaker than the last time, usually you're going to break through it. So if we don't see any kind of turnaround here in the near future, we could be seeing higher gold prices already.
We really need to break above that 1825 for a lot of technical reasons, right? If we close above that, that's the most bullish activity, right? Then that may get investors off the fence, or it may have us as brokers and advisors telling investors to get off the fence if you're in a cost average type of scenario. I'm not buying it yet. I'm going to play devil's advocate for just a second. Going back to March of this year, we had a spike to the previous all-time high.
Right.
That was driven by a news event. Okay, that was driven by the Russian-Ukrainian deal. We were clearly in the early stages, and had been for a few months, of this decline in the gold price as a response to interest rate hikes and the play out of the inflationary numbers and the reaction to them. I think that this week is a reaction to the Bank of Japan. And we saw a massive yen rally on the U.S. dollar index in relation to the U.S. dollar. The U.S. dollar is now down 11% in just a matter of 2 months in that same period of time against the yen. And that's significant. But until we break above the 1825, even though we're sitting almost right at it today, the proof is in the pudding. Does it break out or not? And I'm going to lean towards your original theory in that we see a correction back down, especially based on the time of year. And we need additional news. This news item wasn't able to break it out above. It just drove it, like you said, to the technical point that it was going to go to. What makes it break out above that? That I don't know, especially because gold could weaken too, just with the playing out of recessionary numbers. You see a little bit of a rally here in the U.S. dollar. You see a little bit of a rally here in the equities markets, and that could initiate that reversal down again. So The charts are the charts, and I love it. I'm just going to give most of the credit for this kiss at the ceiling here to this Bank of Japan surprise news.
Right. So if we're going to continue down the path of bizarro world where you're the pessimist and I'm the optimist as far as the price of gold moving around, I will say this. If you're wrong and we do get a breakout to the upside, I don't see anything stopping us till 1900.
I totally agree.
And that's the part that scares me is breakout moves can be aggressive. We saw what happened on the breakout move back in November when gold goes from 1620 to 1660, and then all of a sudden it's 1800. Traditionally, I tend to err on the side of letting markets behave naturally. Corrections are natural. So I think the argument remains that you're correct, and what I suggested last week remains correct, that we could see further downwards movement over the next couple weeks. We're not talking over the next 3 months. We're talking over the next 2 or 3 weeks until we see that kind of breakout. So the opportunity one way or the other is right around the corner. Either we see a slightly lower price before we come up and test it again, which offers great entry opportunity, or we have a breakout and next thing you know, we could be $100 higher. So you don't want to play around when markets are moving.
Yeah, I totally agree. And that's why I would say get off the fence if you see it close above that 1825. Don't wait because there is a lot of room. So how does it coincide with what you're seeing in the charts with the dollar, maybe even other markets? You've pointed out this potential dollar decline. Well, you got it below 104 as soon as Japan shocked the global markets with expanding its target band for 10-year yields. You got that drop below 104. Is it low enough to be that slight correction that you thought you were going to see before the dollar rally?
Well, it certainly could be. I mean, the whole point here is, did we get a move below the August low? Did we break that lower end of the head and shoulder? A penny or $1 million doesn't matter. Doesn't matter if you win by an inch or a mile. So for me, and the fact that we've come back up and tested it as a ceiling once, now we're pushing back up towards it again today. So it's very likely we could break above, but that's enough for me. I would have liked it to go a little bit lower, but that's only because I like nice, perfect geometric shapes, and sometimes you don't get that. So, but it was definitely enough. I would also argue that we're seeing some confirmation of this in the silver market, which, unlike gold, is back to like April pricing. Silver has had a significant run up. Silver saw a similar topping action back in the beginning of November when we were stuck at that 22 mark. We had a slight reversal back down. I thought it would be bigger, and it wasn't. Boy, isn't this sounding ominous. Me thinking we're going to have a bigger correction than we are before we just shoot up to the next resistance. And just like I'm warning with gold, silver has just taken a couple really nice strong steps up to the $24 mark. So here we are. If you want to see what I think gold could do over the next few weeks, look at the silver chart.
So where does silver go from here? We've matched that previous high in silver as well. Are we now hitting our head on the ceiling?
Yeah, can we change places again? Can I be a pessimist again? Because yes, I do think silver's going to run out of steam here.
Okay.
So yeah, I think silver is going to run out of steam. I threw up a chart last week showing that if we saw this continued growth, I figured we'd run out of steam around like 24.50 with a decline maybe down to around 21 or 22. So I think that's completely reasonable here. It's not that I'm a bear. It's just in a bull market, I want to see markets take natural, healthy breathing room.
That's exactly right.
And that's all.
I don't like large separations from moving averages.
Exactly.
Right. So as we come back down, and the moving average trend can be up, and that's great. But if you run away from it, even in a climbing market, you can pretty much bet that you're going to come back down and touch the moving average.
And then finally, it doesn't have anything to do with the general theme of gold, silver, and the dollar, but just because it's an enigma, I will throw up the platinum chart this week because it is hard stuck in this sideways compressing pennant, which means massive breakout is pending. There's really no way to say one way or the other, although the trend has been up since September, so that does tend to lean a little bit more that direction. But just like silver, platinum has reached March pricing and is now trading sideways in between that and $1,000, which is a huge trading range. So platinum remains enticing to me as we're sitting in this stall position because of some of the other things we talk about on the grander scale, like gold-silver ratio, and in this case, platinum to gold and platinum to palladium ratio. And finally, on charts, before we look at a couple other things here, woe to the Dow Jones Industrial Average, with a crushing defeat over the past week. Significant decline, significant lower low, significant trade opening gap that I don't know if it's going to close on this move back up. Dow may be on its way back down for the 11th time in a row that we've, or however many it's been now.
10 straight. Although it is, finally up today. It's having a decent day, but that does not make a trend. Right?
Well, and what scares me with the Dow is I think there's a really good chance by next December we'll be sitting here having a similar looking chart that had been bouncing up and down, except this time it's bouncing between like 26 and 28,000 instead of between, 30 and 33. And that's the part that makes me nervous. I think there's a very good chance you see the Dow down another 5,000 points on average next year.
I just don't know how it can't happen, Miles. And this time the precious metals aren't going to follow it. Much like we said last week, 2008, initially gold can drop and silver can drop in a declining equities markets, but they'll lead the charge back up by many months. And it's almost a consensus out there that a deepening recession is coming. Technically, I think we're in one, but J.P. Morgan has warned that a recession is very likely next year. Bank of America forecasts a recession in the first quarter, with GDP falling next year and unemployment rate rising. UBS calling for a recession in 2023. Wells Fargo is pricing in a recession in about the third quarter of next year. So they're all saying, at some point this is going to happen. If a recession happens, equities markets turn down. Those two things happen in coincidental fashion. So to me, capital economics, no exception. Powell has shown no indication of reversing course. And yet there are these days where the equities markets just can't accept that. It's like they're waiting for the next round of QE. QE is the drug, the quantitative easing, the easy money is the drug, and the addicted are far too optimistic of more doses coming rather than just accepting the reality. The Powell's drawing a very hard line here. So again, I think the metals will lead the charge. I think the equities will lead the charge down. And this will play out very, very similar to the first half of 2009.
Well, the real estate market gets it.
Yep.
Seasonally adjusted November new housing starts down over 16%.
That's
between
also the 10th
November
straight
21
month.
and November 22 this year. So that's a significant decline year to year in new housing starts. And you know what else gets it? The bond market.
That's right. That's exactly right. With unemployment, existing home sales, the bond market, this consensus of expert analysts, all of that points to that playing out to be the case. So stay the course, but welcome a little bit of a pullback here. And let's watch those lines that we need to break through. And if we break through, we really could be continuing this trend and really off to the races.
So that's going to do it this week on Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell, ask your questions in the comments. And if you want to learn more, you can head on over to our website at McIlvaney.com. We can also be found on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you want to discuss your personal portfolio with one of the advisors here at McIlvaney Precious Metals, you can reach us at 800-525-9556. Thanks for listening and have a great week.